Hi there, it's Friday the 12th of April 2019. I'm Steve Towers. Welcome to ITB. Let's get started. The big news of the week on digital taxation is that France's DST bill has been passed by the National Assembly. It will now go to the upper house, the Senate, in May. Commentators expect the bill to receive Senate approval by the end of May. Meanwhile, the US has continued its criticism of DSTs in general and France's DST in particular. Last week, this included arguments made by the US Secretary of State Pompeo in a face-to-face meeting with his French counterpart, and a letter sent to President Trump by a group of Republican congressmen who called on the president to engage forcefully on this issue. Then this week, the bipartisan leadership of the US Senate Finance Committee and the House Ways and Means Committee issued a statement which both endorsed the multilateral OECD approach and criticised the unilateral French DST. For a copy of that statement, please go to our website or app. But it's all water off the French duck's back. A French National Assembly member was quoted as saying, "Our response is twofold. First, France is a sovereign country that conducts its own tax policy. Secondly, I don't see how a trade war could be started by a tax that raises 400 million euros. And in Mexico, the Deputy Finance Minister said that a DST will likely be included in the country's 2020 budget proposals. The OECD has released for public comment a draft working paper on tax morale. The draft working paper includes empirical analysis on social preferences and attitudes to taxation around the world. The OECD has asked for public comments by the 10th of May. For your copy of this document, please go to our website or app. The UN has released a second tranche of documents in preparation for the next meeting of the UN Committee of Tax Experts on the 23rd to the 26th of April. In last week's ITB, I covered the first tranche of 6 documents released by the UN. Here's the second tranche of documents. Please hit the pause button if you'd like to study the list. And if you'd like a copy of the documents, you can find them at our website or app. The IMF has issued a report on curbing corruption, which includes an assessment of the relationship between corruption and tax revenues. This report presents evidence that the fiscal costs of corruption can be substantial for economies at all levels of development. For example, comparing countries at similar income levels, the least corrupt governments collect 4% of GDP more in tax revenues than their peers with the highest levels of corruption. Based on such cross-country comparisons, if all countries today were to reduce corruption by a similar extent on average as those that reduced it over the past 2 decades, global tax revenues could be higher by $1 trillion, or 1.25% of global GDP. The gains would likely be greater considering that lower corruption would increase economic growth, further boosting revenues. For a copy of this report, please go to our website or app. In Australia, the tax authorities have released several items of guidance. Let me take you through them. First and foremost, draft guidance has been released on the operation of the so-called FISLA Targeted Integrity Rule under the Hybrid Mismatch Rules. Let me give you a little background. Australia has enacted hybrid mismatch rules which are modelled on the BEPS Action 2 final report. But the FISLA Targeted Integrity Rule goes one step further than the BEPS approach. The hybrid mismatch rules include the Targeted Integrity Rule, which seeks to prevent offshore multinationals from otherwise circumventing the hybrid mismatch rules by routing investment or financing into Australia via an entity located in a no or low tax, 10% or less jurisdiction. Were it not for the Targeted Integrity Rule, the interposition of such an entity would otherwise effectively replicate a DNI mismatch, but fall outside the scope of the operative provisions pertaining to a DNI mismatch. In other words, in situations where there is no hybrid mismatch, but there is a significant tax rate differential between the Australian corporate income tax rate and the offshore tax rate, the FISLA Targeted Integrity Rule can apply. Here's a simple example of where the FISLA Targeted Integrity Rule can possibly apply. Foreign parent company owns two 100% subsidiaries, Ostco, an Australian resident company, and Cayman Islands Co., a company based in the Cayman Islands. Foreign Parent Co. funds Cayman Islands Co. with equity. Cayman Islands Co. uses that cash to make a loan to Ostco, the interest rate on which satisfies the arm's length principle. Ostco obtains an Australian income tax deduction for its interest expense at the 30% corporate income tax rate. There's 10% Australian interest withholding tax on the outbound interest payment. There's no Cayman Islands tax on the interest income, and the interest income is not attributed to Foreign Parent Co. under the tax rules of its residence country, either because that country does not have CFC rules or because of the operation of those rules. So with this example, there's a tax rate differential, 30% tax benefit for the interest expense versus 10% tax cost on the interest income. The draft guidance discusses a number of issues which relate to the Targeted Integrity Rule, including these: the control test and how to determine the ultimate parent entity of the group, the subject to foreign income tax test, which includes issues such as taxation on a remittance basis and concessional tax rates, the principal purpose test, which applies in the Targeted Integrity Rule, and back-to-back arrangements. The second item of guidance is a draft ruling in regard to the arm's length debt test under Australia's thin capitalisation rules. Under those thin cap rules, the maximum allowable debt is the greatest of these three amounts: the safe harbour debt amount, which uses a statutory ratio, the worldwide gearing debt amount, and the arm's length debt amount. So the draft ruling considers the third of these three amounts. The most interesting part of the draft ruling is the discussion about the relationship between the arm's length debt test under the thin cap rules and Australia's transfer pricing rules. The draft ruling states that the two sets of rules are different and thus they won't necessarily produce the same outcome. The arm's length debt test is a statutory test that requires the determination of a notional amount of debt to be arrived at after taking into account the assumptions list in the legislation. It is not a test applied to all the facts and circumstances of the entity, and is instead a test applied to the facts and circumstances prescribed to exist. An entity applying the arm's length debt test must assume no guarantee, security, or other form of credit support is provided to the entity from its associates, and that the only business is the Australian business of the entity. No equivalent assumptions exist in determining the arm's length conditions for the purpose of the transfer pricing rules. There are two other items of guidance which have been released by the Australian tax authorities. A draft taxation determination on the definition of financial intermediary business for the purposes of Australia's CFC rules, and some draft amendments to a 2004 GST ruling on securitisation arrangements. For a copy of all of these documents, please go to our website or app. And one more story from Australia. The government has launched a public consultation on the gas transfer pricing arrangements of the PRRT, the Petroleum Resource Rent Tax. For a copy of the consultation document, please go to our website or app. In China, the customs authorities have issued guidance in regard to the procedures to declare and pay customs duty on dutiable royalties, royalties which are relevantly connected to imported goods and which must be included in the customs value of those goods. The guidance is effective the 1st of May 2019. For a copy of the guidance, please go to our website or app. It looks like the Indian subsidiaries within US groups will need to file the CBC reports with the Indian tax authorities after all, at least for the near future. You'll remember that the two governments agreed to a CBC report exchange mechanism in late March. That mechanism will excuse Indian subsidiaries of US groups from having to file the CBC reports with the Indian tax authorities, but not just yet. In an order issued on the 8th of April, the Indian tax authorities note that the exchange mechanism with the US would come into effect only after both the countries notify each other about the completion of all internal procedures for exchange, which is underway. Due to non-notification of the agreement and resultantly non-activation of the exchange mechanism between India and the USA, the CBC report has to be filed by the Indian subsidiaries whose parent entities are resident in USA and whose reporting accounting years ended after February 28, 2018. The Central Board of Direct Taxes hereby extends the period for furnishing of the CBC reports by such Indian subsidiaries in respect of reporting accounting years ending up to April 29, 2018 to April 30, 2019. For a copy of the order issued by the Indian tax authorities, please go to our website or app. And let me quickly mention two recent cases in India. In the first case, the taxpayer sells travel products to its customers through its website. When a customer enters into a transaction, the payment is made through a so-called internet payment gateway operated by the customer's bank. The bank charges a fee to the taxpayer for the use of its internet payment gateway. The question in the case was whether that fee was a commission. If it was, the taxpayer would be required to withhold tax from the fee. The Delhi High Court held that the payment was not a commission, which refers to a fee paid by a buyer or seller of goods to an agent acting on its behalf. That was not the situation here. The second case is called ULO Systems. If that name sounds familiar, it's because I dealt with a case concerning the same taxpayer, the same facts, but a different tax year in ITB on the 18th of January. Both cases were decided by the Delhi Income Tax Appellate Tribunal, although there was a differently constituted bench in the two cases. And would you believe it? A different conclusion was reached. In the first case, the tribunal held that the taxpayer's grouting service, which involves the laying of a layer of cement on an underwater structure, does constitute construction for the purposes of the PE definition in the India-UAE Treaty. And in the second case, the tribunal held that the same service does not constitute construction. For a copy of these two cases, Make My Trip India and ULO Systems, please go to our website or app. In Indonesia, the government has issued a regulation which significantly increases the range of export services which qualify for zero rating for VAT purposes. The regulation is effective the 29th of March 2019. This is an important development. Under the prior law, many types of export services were subject to 10% standard rate VAT, for which no benefit could generally be obtained. Here's a list of the types of export services which now qualify for zero rating. Please hit the pause button if you want to study the list. For a copy of the new regulation, please go to our website or app. In Malaysia, Parliament has passed the legislation which will impose a 6% service tax on B2C inbound digital services, effective the 1st of January 2020. You'll remember that this was proposed in the 2019 budget. Foreign service providers will be required to register for Malaysian service tax if they expect or actually do exceed aggregate taxable supplies of 500,000 Malaysia ringgit, which is about 120,000 US dollars in a 12-month period. And the penalty for failing to register includes imprisonment. For a copy of the legislation which has been passed by Parliament, please go to our website or app. In New Zealand, the Court of Appeal has dismissed an appeal in the Chatfield case, which concerns the Exchange of Information article in the New Zealand-Korea Treaty. You might remember the lower court decision. I covered it in my previous video podcast series in January 2018. A quick reminder of the facts. The Korean tax authorities requested certain information from their New Zealand counterparts in regard to a New Zealand resident taxpayer who is a Korean citizen. The New Zealand tax authorities did not have all of the information themselves, and so they issued a notice to the taxpayer's New Zealand tax agent to provide them with some of the information. The New Zealand tax agent challenged the validity of the notice. The lower court found in favour of the New Zealand tax agent. The tax authorities then appealed to the Court of Appeal, and the Court of Appeal has now dismissed that appeal. For a copy of this case, please go to our website or app. The European Commission's VAT expert group had a recent meeting at which they discussed a number of issues, including VAT quick fixes, the VAT treatment of the sharing economy, and the VAT treatment of financial and insurance services. For the agenda and all of the documents presented at the meeting, please go to our website or app. One particular point I should note is in regard to the document on the VAT treatment of financial and insurance services. It indicates that the Commission will be undertaking a study of the current VAT exemption of those services, especially in the cross-border context. That should be interesting. In Germany, the Federal Tax Court has decided a case in regard to an upstream merger between two companies within a German fiscal unity, an Organschaft. A third-tier German subsidiary was merged into a second-tier German subsidiary, both within the Organschaft. The tax authorities argued that the merger gain should be only 95% exempt instead of 100% exempt. However, the court rejected that argument. It held that the merger gain was 100% exempt. For a copy of this case, please go to our website or app. In Italy, the tax authorities have released a resolution in regard to the application of financial transaction tax on the transfer of shares in an Italian company. The transferor and transferee companies were resident in the Netherlands and the UK, respectively. They were also under identical ownership. The tax authorities stated that the transfer qualifies as an exempt reorganisation, and thus FTT does not apply. For a copy of this resolution, please go to our website or app. Norway and the EFTA Surveillance Authority are in discussions as to whether the Norwegian rules for reporting obligations concerning non-resident contractors breach the European Economic Area Agreement in regard to the freedom to provide services. The EFTA Surveillance Authority sent to the Norwegian government a reasoned opinion on this issue in December 2018. The Norwegian government has now responded. For a copy of the response, please go to our website or app. In Poland, the government has further delayed the introduction of a mandatory VAT split payment system until the 1st of January 2020. The EU Council gave Poland approval to operate a mandatory VAT split payment system from the 1st of March 2019 to the 28th of February 2022. A voluntary VAT split payment system has operated since July 2018. In Romania, the government has issued an ordinance which amends the financial assets tax, commonly referred to as the greed tax. The amendments will generally reduce the amount of the tax. In particular, the tax base will be reduced and the tax rates will be fixed based on the bank's market share instead of being linked to the Romanian interbank offered rate. Also, the tax will be paid on a 6-monthly basis instead of the original quarterly basis. In Zambia, the bill for the introduction of sales tax to replace VAT, effective the 1st of July 2019, has been introduced into Parliament. The sales tax rate for local sales of goods and services will be 9%, and for imported goods and services, the sales tax rate will be 16%. For a copy of the bill, please go to our website or app. In Brazil, a bill has been introduced into the Chamber of Deputies to simplify the country's complex indirect tax system. The bill proposes the introduction of a federal VAT, which would replace 5 existing taxes. Interestingly, the proposed transition period for this replacement would be 10 years. For a copy of the bill, please go to our website or app. Also in Brazil, the tax authorities have released a private ruling in regard to the tax treatment of a cost-sharing agreement. For a copy of the ruling, please go to our website or app. In the US, trade tensions with the EU have increased. This week, the US Trade Representative proposed additional ad valorem customs duties of up to 100% on a list of 326 goods imported from the EU as a countermeasure to EU subsidies for Airbus. For a copy of the Trade Representative's announcement, which includes a preliminary list of the 326 types of goods, please go to our website or app. The US Court of Appeals for the Fifth Circuit has applied the economic substance doctrine to deny a deduction for artificial losses generated from a tax shelter transaction. For a copy of this case, please go to our website or app. And the tax authorities in the US state of Georgia have issued an interesting ruling. The ruling concerns a Canadian company which derives income from US customers, but is exempt from US federal income tax on its profits because it doesn't have a PE in the US under the US-Canada Treaty. From Georgia's viewpoint, the issue is whether the Canadian company is taxable or exempt in regard to Georgia corporate income tax. The US-Canada Treaty does not provide an exemption from US state taxes. However, the computation of taxable income under the Georgia law is taxable income as defined in the Federal Internal Revenue Code, subject to certain specific state modifications. If the Canadian company is exempt from US federal income tax under the treaty, its taxable income under the Federal Internal Revenue Code would be nil. That would mean that the Georgia taxable income also would be nil, subject to those specific state modifications. Very interesting. For a copy of this ruling, please go to our website or app. And now for this week's treaty developments. We've had 2 treaties signed, including a new Kenya-Mauritius treaty, which replaces the treaty which was declared in March by the Kenyan High Court to be legally ineffective in Kenya. Let's hope they follow the correct procedures for this new treaty. We've also had 1 treaty enter into force and 1 protocol signed. I have 1 article for you this week. It's called Spiritus Ex Machina, addressing the unique BEPS issues of autonomous artificial intelligence by using personality and residence. It's written by Lucas de Lima Carvalho and it's published in the Intertax Journal. According to the author, the premise for this article is a specific statement made by the OECD in the final report on BEPS Action 1. In trying to justify its base assertion that it would be difficult, if not impossible, to ring-fence the digital economy from the rest of the economy for tax purposes, the OECD declared that while the digital economy and its business models do not generate unique BEPS issues, some of its key features exacerbate BEPS risks. This is a grave misconception about the core of Action 1, and neither the interim report released in March 2018 nor the policy note released in October 2018 seem to have corrected it. True, the digital economy does exacerbate select BEPS risks, but it is senseless to either suggest that it does not create unique BEPS issues or attempt to conform new challenges posed by the digital economy to old standards used in the international tax space. The article is focused on autonomous artificial intelligence, AAI, which is the next wave of the artificial intelligence, AI, revolution. The author defines AAI as an AI system which, 1, is capable of performing tasks commonly associated with human intelligence and beyond, 2, is not directly or indirectly controlled by human beings, and 3, importantly, has full managerial power over its own actions and resources. After elaborating on AAI, the author considers the key tax issue with AAI. How does a country impose income tax in regard to an AAI's activities, particularly in the cross-border context, when it, the AAI, lacks legal personality, it's not a person, and it's not a resident of anywhere? A critical aspect of this issue is the word autonomous, the first A in AAI. The AAI is not controlled by a legal person. To illustrate this point, the author gives several examples. Here's one. Exco, a company resident for tax purposes in state X, hires an AAI system to process the historic performance data of its equipment. Let us assume that there are elements to support the claim that if this AAI was a person, it would not be a resident of state X. Suppose, for example, that the AAI was originally programmed and built by a company in state Y, and that it was left to operate and use servers located in state Y. Exco then transfers cash from its bank account in state X to the virtual wallet of the AAI in consideration for services provided. In this example, which jurisdiction gets to tax the remuneration for the services rendered by the AAI to Exco? State Y has no claim on that income whatsoever. Not only is the AAI not regarded by its domestic law as a person, but it is also not regarded as a tax resident under existing legislation. State X could attempt to tax that income at source, arguing that Exco should be held liable for the tax burden of non-resident service providers. However, who is the non-resident service provider in this case? The AAI is not viewed as a person by State X, so a payment from Exco to the AAI is the digital equivalent of burning money or throwing it off a window. It leaves the pockets of Exco and it disappears into the digital realm, at least as far as the tax authorities of State X are concerned. There is no denying that Exco received an economic benefit from the AAI, but that economic benefit cannot be associated with a corresponding tax collection without a legal basis for that association. That legal basis is yet to be discussed and created in domestic tax systems today. To be honest, I have some difficulty with this example. I understand that the AAI is not controlled by human beings, and it has full managerial power over its own actions and resources. But it was created by a company resident in state Y. Presumably at that time, that company was the legal owner of the IP which comprises the AAI. After that time, the company has lost control of the AAI, but would it not still legally own the AAI? And if legal ownership is still there, why would that company not be the relevant taxpayer in regard to the service fees? Now, it might seem a bit harsh to impose tax on that company if it has unintentionally lost control of the AAI, but that's a different issue. What do you think? Well, that's the way it is this Friday, the 12th of April, 2019. The ITB team will be having a well-earned one-week break. We'll be back full of life on Friday, the 26th of April. Until then, I'm Steve Towers. Have a great weekend.